I'm John Hanna for CDTV.net here in New York, and we have David Madigan, Chief Investment Officer for Breckenridge Capital Advisors, joining us from Boston, Massachusetts. Thanks for joining us, sir.
Well, thank you, John.
Well, sir, pretty much the focus of your company there is bond investments, right?
Yes, we do primarily high-grade intermediate bond investments.
Okay. Well, let's talk about the bond investment climate uh, in today's market. What can you tell us about the bond market right now?
Well, right now, overall, what we're seeing is just a real lack of activity. We're into the end of summer, week before Labor Day. The markets have been fairly quiet, but the Treasury market's been very volatile. And it's been following equities, pretty much a negative correlation. If equities are down, Treasuries are up, and most of the bonds are up. Although the volatility has been on very low volume from what we've seen. So what we're seeing now are, if you look at the 30-day volatilities on any of the Treasuries out to 5 years, they're well over 100%. Some of them up close to 1,000% volatility. So you really are just kind of shooting in the dark. A lot of that has to do with the very low yield environment that we're in. The pretty much consistent negative economic news that's been coming out over the course of the last month has really driven rates down over the course of the month, and long-term Treasuries most of the funds had returns of about 3% for the month of August, and that makes the yields a little less attractive for longer-term investors, and particularly income investors, which are primarily what we'd see coming into the bond market.
Now, has there been a shift from people going from bond to equities or vice versa?
We have seen a shift from, or at least a lot more talk about moving from bonds into dividend stocks. And that's been a discussion that's been going on. The problem with doing a move like that, particularly for income investors that are looking for a stable value, is that you're introducing the equity volatility that's been into the market that supports the dividend stocks that you're going to be moving into. We've seen that repeatedly recommended. So far, we don't believe that there's been a major movement in that direction, at least when you look at the fund flows and everything else. But it is one of the topics that people are talking about. And if we do come into, which is average returns in September for the equity market tend to be negative over the last 20 years or so on average, you may be able to get some opportunities towards the end of the month to do that type of a trade. But overall, we think bonds are still, the stable area of the market. It's where everybody has come to really kind of settle in a calm port while the market continues to be very volatile. And if you read any of the outlooks and any of the economics that are out there, there's a real disagreement over what direction we're going right now. Are we moving into a Japan-type scenario where a 10-year Treasury at 1% would be easily conceivable, or are we moving into an inflationary scenario, which is really a lot of what the Fed has been trying to create, which will then solve a lot of our debt problems by just inflating us out of them. Either one seems just as likely at this point, and I think it's just the uncertainty in the market that's driving a lot of the investment into the high-grade sectors, and that's what's keeping yields so low.
Uncertainty in the market as to what now? The government's action throughout the world, or other market influences?
I think a lot of what's happening with the government influences is coming out of Europe. There's a tremendous uncertainty as to how the euro is going to work its way through the debt problem that they have. And with the austerity that's gone in almost across the board in most European governments, there is no government fiscal stimulus at all going on in Europe. So we expect the growth in Europe to remain very subdued. In the U.S., we're now beginning to follow that same pattern, where we're getting into talking more about debt ceilings and debt levels rather than talking about what the government could be doing going forward to actually help the economy. It'll be interesting to see what comes out next week when President Obama makes his pitch for what type of stimulus or what type of fiscal activity should be going on in order to begin to stimulate some growth in the U.S. A lot of what we've seen so far has just been very much indecision and coming out of Washington from both sides, and there hasn't been a real push from either side in order to get any real policy going. On the monetary side, you've got the Federal Reserve, which has pretty much hit their limit. I think announcing QE3 would see an immediate spike in yields and an immediate spike in the inflation expectations going forward. So I'm not sure that the market's prepared for any more monetary stimulus. And so the fiscal stimulus is really kind of the only card they have left. And whether that be a tax reform or some type of change in the method of spending money, that's really what we need to look for.
With regards to municipal investment, when you look at a municipal area, I've seen some reports in the past that say, for example, this particular county is paying, the superintendent like $5 million a year or something like that, outrageous number. Are those the kind of stuff that people like yourself or companies like yourself stay away from?
Well, we focus on those kind of things, but really what you're talking about is what happened in Bell and Industry, California. Bell is an interesting case in that, again, it's a very small town, and the tax base is primarily commercial, so individual voters didn't really pay any attention to what they were getting paid until, obviously, it became very well known, and they cleaned house. They have the similar type of things. There's a town called Industry, California, which has the same kind of problem. I think it has 2,500 residents, but the town budget is huge because it was built originally as a warehouse site for companies and warehouses, and so they pay all the property tax. Those are the types of areas now that California is looking at and saying, that really shouldn't be a separate incorporated town. That should be part of the city that it's attached to. And those are the kind of reforms that will probably come in and eliminate that kind of a problem. I think if you look overall, and I know in Massachusetts they're very good at publishing all of the public salaries that are being paid. Our local paper lists every town employee and what they make every year in the paper. So there's no mystery, and as long as it's not a mystery and people are paying attention to it, those kind of problems don't develop. And if they do develop, they don't last very long. So those are kind of, really one-off kind of weird circumstances that took place because of the way the California towns had been set up.
Okay. Now, with regards to what Obama might be talking about next week, what are you looking for as a bond investor?
I'm not sure. I really have very little idea of what he's going to come out with. I assume there will be some tax reform talk because in the committee of 12 of the people that they've picked, a number of them, you got the head of House Ways and Means, Senate Finance. You've got people that are very into, writing the tax code. So that, I assume, will be one of the things he'll talk about. We'll probably get some more of the green energy or green investments that need to be made, and that would be kind of what he'd be pushing for any kind of stimulus going forward. And the last part would be something with infrastructure. That's been kind of an issue across the board, both in municipals and nationally, is if you look at what the hurricane did. We had one of our analysts said, the best infrastructure project they could do is take all the power lines on the East Coast and bury them, rather than having all these high tension wires everywhere that get knocked over by trees. That would certainly have saved us from having 5 million people without power on Monday morning. So there are those kind of projects that are out there, bridges, roads, drive on the highway, and, a lot of them are going right downhill. And it's because nobody has any money to spend on that kind of thing. And that would be where, some kind of stimulus package would probably come into play, and we would think that's what he would be talking about. Beyond that, I'm not sure what other things might come up. He's had a week to think about it on Martha's Vineyard.
So where's the best right now with regards to bond investment at this time?
Well, we believe that still being intermediate, out to 10 years in the muni market, in that 1 to 15-year range in the corporate taxable markets, is really where you want to remain. Because what we've seen so far is that if you had a 1 to 10-year portfolio at the end of July 2010, the average yield on that portfolio was about a 180 to 2%. If you look at that again at the end of July 2011, the yield is still between a 175 and a 2%. But the total return on that portfolio over the 12 months is well over 3%. And that's because the yield curve is so steep out to 10 years, we're getting a lot of roll down the curve. So a 10-year bond becomes a 9-year bond. A 9-year bond becomes an 8-year bond. And that builds in a lot of cushion into the pricing of the bond so that if rates do begin to go up, if there is a perception that inflation is coming, your bonds are shortening up quickly enough that they will be less exposed to any major shifts in the yield curve. Other than that, I think being out long in bonds right now is probably fairly risky. In the municipal market, there aren't a lot of buyers out there, and there hasn't been a lot of supply of bonds. So the liquidations going through the mutual funds have been consistent. They broke their 42-week streak of having withdrawals for 42 weeks in a row, but they have gone back into, we've seen several weeks in a row again of withdrawals coming out of bond funds and liquidations. And more importantly, what we saw this past week was $2.5 billion coming out of money market funds, which is probably going to be the next thing that everybody's going to be talking about. If the euro crisis continues, the second level of that is banking in the U.S., but more exposure is the money market funds in the U.S. that use European bank-backed debt and supply a lot of liquidity to the European banks. And that's probably where we think the next shock is going to come, is in the very short end. So in our portfolios, we've tried to maintain as little cash and get things invested in fixed-rate bonds as much as possible.
Because then you've locked in already your rates now, right?
Right. You've locked in your rate, and you're not exposed to any of the LOC risk that's out in the market in the money market funds.
There you go, folks. David Madigan, Chief Investment Officer, Breckenridge Capital Advisors, joining us from Boston, Massachusetts. And I'm John Hanna for CDTV.net in New York.